I just wanted to check when there is a startup which is a pre-revenue stage or just at ideation stage, they might have but they have not even gone to the market. So what is the kind of due diligence you will make there?
In that case, if this is just an idea, you can only do the due diligence of the founder, the idea, the market size, but nothing much is available in our hands. So it's a kind of uh, higher risk in comparison to a startup which is making revenue, but obviously higher risk equals to higher profits, and that is why we ask all the founders, all the investors to just put in 50,000 and only put that amount if you can afford to lose. So if you invest into 10 such startups, just 50,000, even if one startup performs good, it will cover up your entire 10 startups investment plus give you 2-3x profit. So maybe your 50,000 will become 15,000, 20,000, sorry, 15 lakh maybe, or 20 lakhs maybe, if you stay, if only one startups become unicorn or does very well in 5-6 years time. Because we have the cases like 4.7 crore invested by Sanjeev Bikhchandani in Foodie Bay, the Zomato, became 22,000 crore at the time of IPO listing. So, and there are certain failure stories as well. People invested crores into companies, local bania went off in the air. So both sides are there. And generally, if you are putting into a company which is not burning much, your money is safe. And in this case, idea stage startup, we check what is the background of the founder, so whether they will be able to exercise the buyback. If they are just hand to mouth, then we try to avoid them to protect our investors.